Okay, so picture this. You've got a company that is just firing on all cylinders. Its stock is soaring, investors are happy, and then, out of nowhere, a top Wall Street analyst downgrades it. I mean, that sounds completely backward, right? Well, that's the strange but very true story of Allegiant Travel.
So why on earth would a stock that's posting these incredible gains suddenly get a tap on the brakes from an expert? It feels totally counterintuitive. But, figuring this out actually reveals a really important lesson about how the market really works.
And I mean, just look at these numbers. They're staggering. A 68% gain in just 6 months. And more than half of that came in the last month alone. This isn't just good performance. This is an absolute knockout. So when you see a chart that looks this good, that downgrade becomes an even bigger mystery.
All right, so to solve this puzzle, we're going to have to pop the hood a little and see how these Wall Street ratings actually work. Because as we're about to find out, the headline rarely ever tells the whole story.
And here is our very first clue. The rating didn't just plummet from buy down to sell, it was much more subtle. It just shifted from strong buy to outperform. It's kind of like going from an A+ to an A. It's still a fantastic grade, right? It's just a little signal that maybe, just maybe, the easiest gains are already in the rearview mirror.
And this quote right here, this is the key. The downgrade wasn't because the company's doing poorly, it's because the stock was doing so well. The company's fundamentals, its core business, are solid. The only problem, if you can even call it that, is simply that the stock price has already shot up to reflect all of that good news.
This brings us to a super important concept, stretched valuation. Here's an easy way to think about it. Imagine a fantastic house in a really hot real estate market. It's still a great house, but after its price is skyrocketed, it's not exactly a bargain anymore, is it? You might say, yeah, wonderful property, but it's fully priced. That's exactly what's happening with Allegiant stock. All the good news is already baked into the price.
So we know the stock soared and got fully valued, but why did it soar so high in the first place? What was all the good news driving it? Because, this wasn't just some random market fluke. There was a real story of success behind those numbers. It really boiled down to 3 key things. First, Allegiant was fixing some internal issues, and investors always love to see that. Second, they got rid of a project called Sunseeker that the market kind of saw as a drag on their business. And finally, all the investors who were betting against the stock, the short sellers, they basically had to give up and buy back shares, which just pushed the price up even faster. And the positive story doesn't even end there. The company has a really clear roadmap for future growth. They're focused on making their new routes more profitable, adding more of those high-margin premium seats, upgrading their tech, and bringing in brand new super-efficient MAX aircraft. Every single one of these steps is designed to boost earnings and show that the company's solid performance is set to continue.
Of course, even a great company can struggle in a bad market. So how healthy is the environment that Allegiant is operating in? Let's zoom out for a second and look at the entire U.S. airline industry.
And the bigger picture is actually pretty encouraging. We're seeing a few key positive signs all across the industry. The consumer outlook has improved. Airlines are being smart about not adding too many flights, which helps keep prices stable. And because of all that, the whole industry is on track for some pretty steady growth into 2026.
I mean, at the end of the day, airlines need people who want to fly. And right now, demand is strong. There was a brief dip, but it bounced right back and is tracking right along with expectations. That underlying strength is a great sign for all the U.S. carriers, and that includes Allegiant.
All right, so we've seen the strong company, the hot stock, and the healthy industry. So what's the real lesson here? What does this strange downgrade actually mean for you? So let's go back to our original question. Is this actually bad news? And the answer is a definite no. In a weird way, this downgrade is kind of like a trophy. It's the analyst's way of saying, wow, this company did exactly what we hoped, and the stock already delivered the amazing results we predicted. Mission accomplished.
So, what are the big lessons here? Well, first, a downgrade isn't always a reason to panic. Second, a stock's price can matter just as much as the company's actual performance. Third, and this is probably the most important one, the why behind a headline is absolutely everything. And finally, you always have to look at the bigger picture. In this case, knowing the whole industry is healthy makes all the difference.
And that just leaves us with a final thought. The next time you see a financial headline that sounds shocking or confusing, are you just going to accept it at face value, or will you maybe be inspired to dig a little deeper and look for the real story that's hiding behind the story?